Hi, welcome back to Channel 11. I'm Ken Shinoda, your host. Today's Tuesday, April 9th, and we're going to review March, the land of gains. I guess March kind of went sideways, but this year has been the land of gains in equities at least. Here's a chart of the S&P 500 bottoming in October of last year and rocket ship straight up and to the right. But it's kind of gone sideways since the end of the month. So let's see what CPI brings us tomorrow and what that means for risk markets. But why have equities done so well? Well, one of the reasons is that the recession that everyone had thought was going to hit by the end of last year has not hit, and economic data is starting to surprise to the upside. So here you can see Citi economic surprise indices, US, Europe, China. They had all dipped into pretty deep negative territory outside of, I guess the US wasn't as bad as the rest of the world. And here everything seems to be picking back up with economic data surprising to the upside. On a global basis, we talked about this last month during good times, bad times. When we talked about the mix of data, we had noted that manufacturing PMI from a global standpoint had ticked positive over 50. Services already being over 50, above 50 being expansionary. And one of the things that was part of the bad times last time we had Channel 11 was that manufacturing PMI in the US had continued to be negative, but it just ticked positive for the first time in 16 months. And that was one of those recession indicators now ticking into positive territory. On the right-hand side, also the kind of those recession indicators, LEI, albeit still negative, is less negative. So that finally ticked up as well. So you're seeing some of this more positive economic momentum come in, and the equity market is pricing that in. This is global growth forecasts on the left-hand side. In the yellow is 2024. You can see it's positive on the year, ticked up ever so slightly. In the US, a more dramatic move up. So the US economists forecasting stronger economic growth than they did about a year ago. And this is, again, all why equities have moved higher. Inflation continues to moderate. On the left-hand side, we have core PCE. You can see that's come down now to 2.8%, on its way to the Fed's 2% target. The concern is that will it start moving sideways? And what we've seen in inflation metrics is that the base effects are starting to roll off. So about a year ago, we had positive base effect momentum coming off very high numbers. Now we're coming off lower numbers from a year ago, and so the improvement in inflation is going to decline. So the question is, what's going to happen to these inflation numbers? Rates have backed up, meaning gone higher in yield because of that economic strength. People worried that inflation will pick back up, but let's look a little bit under the covers here. Here we can see what I just talked about. Core PCE has moderated, but if you look over shorter time periods, look at that 6-month annualized number, it's starting to tick up a little bit. So the year-over-year number's down, but that shorter time frame, because of the base effects, has started to go up a little bit, and this is why I think rates have backed up. Now, if we look at the components of inflation, one of the components is rents, and so here you can see in the dark blue line, Cleveland Fed New Tenant Repeat Rent Index. I know that's a tongueful there, but basically different metrics that follow the percentage increase in rents, and we're seeing them turn over. And that 3-quarter lag one is turning over pretty meaningfully. So I do think there's been a ton of multifamily supply that's hitting the market. We are seeing rents starting to slow their pace of inflation. They may even drop as more supply comes in the market. So this is some good news for inflation metrics. The other part of the market that's been holding steady has been the labor market. Labor market drives services inflation, and we're going to look at some different metrics on why maybe services inflation and wages could be slowing down. Here you can see the quit rate. That's in the red with an 8-month lead. It looks pretty correlated to the Atlanta Fed wage growth, and the quit rate has been dropping. And the quit rate's been dropping because it's been harder to find a job. There was a labor shortage after COVID, and so we had articles in the news about kind of the great resignation, people quitting their jobs because the grass is greener, they're going to find something better on the other side. it's hard to find something on the other side now. And so you're seeing that that quit rates is falling, and that should help wage growth slow as it becomes harder to find a job. One of the other things that shows a cooling labor market is the weekly hours worked. This has continued to fall. This is usually falls during recessionary periods. This is probably one of the remaining recession indicators out there is, yes, the jobs numbers have been strong, but hours worked is dropping. So while people may not be losing their jobs, they're working less hours and maybe getting paid less. This is one way for employers to keep their workforce, but maybe cut their costs. So not necessarily a bullish thing to see this come down. Here's another metric I found, probability of finding a job in the next 3 months. I have no idea how this is calculated. Maybe it's a survey. But this coming down also kind of ties in with the quit rate number that we looked at earlier. So it's harder to find a job, less people will maybe try to leave their jobs, and this should help cool wages and put more power back into the employer's hands where it's been in the employees' hands for some time. Here's another good one. This is the NFIB Small Business Hiring Plans Index, another mouthful here. That is in the blue line, and then we have unemployment inverted. And you can see a pretty good correlation that small business is a lot of jobs in America. If they're not hiring, that's not good for employment. And so small business is getting squeezed by high cost of funding, high borrowing costs. So they're less inclined to borrow money to expand their business, and it looks like their hiring has decreased as well. So this is, again, one of those bearish indicators. I know stocks are at all-time highs. Everyone's pricing in for no landing now. Everything's fine, but let's keep our eye out on some of these indicators because they may not mean immediate drop in growth, but it could be a sign that maybe towards the end of the year you do get some slowing in the economy, which would be obviously good for inflation and good for bonds as well. Consumer sentiment had been very poor. This is also starting to recover. It's recovering in line with the drop in inflation and the increase in equity prices. So I'm not surprised consumer confidence has been going up. So all these things kind of hand in hand. Why are stocks up? Why are people maybe starting to worry a little bit about a reacceleration in inflation? Why bond yields have moved higher to the highs of the year yesterday. We got a little rally today, but to the highs of the year across the curve yesterday. Now, what are some of those downside risks that are still out there? Well, look, bank lending is still really low. The high rates have squeezed the banks, both from a deposit standpoint, but their ability and willingness to lend has decreased. What has offset this? Well, I think one of the reasons that we haven't seen the transmission mechanism of higher rates flow to the economy so quickly is that typically the lending markets freeze up, banks stop lending, you can't borrow in the high yield or bank loan market. Well, guess what? There's a $1.6 trillion, $7 trillion direct lending, private credit, private debt market that's raised a ton of money that's been giving debt to these companies to kind of, make them get through this rough patch. The problem is if rates don't come down, eventually those high cost of the funds for these floating rate debt's going to squeeze these companies. So higher for longer is not good for floating rate borrowers. It's already hurting commercial real estate borrowers. It will hurt corporate borrowers at some point in time. Default rates are already elevated from levels that we've seen over the past decade. On the right-hand side, consumer delinquencies, we've been talking about this for a while. They continue to rise. They're not kind of at crazy levels. They've kind of normalized from pre-COVID, but now they're starting to get kind of above those pre-COVID levels, and this is not a good thing. Credit card balances up a lot, meaning people are borrowing now to spend. So that could be a sign of the consumer running out of those excess savings. So rates across the curve, 2s, 5s on the top, 10s, 30s on the bottom. We had a big rally after the Fed, kind of the Powell dovish pivot in October of last year, along with some weaker jobs numbers and also a change in the Treasury funding schedule. So you saw that huge rally. We went from about 5% on the 10-year all the way down to 380. We've backed up to about 440-ish. I think we got to 442 intraday at the peak. We're kind of like 435 today. And we'll see. CPI comes tomorrow, so it's hard to predict CPI numbers, but If it comes in line or lower than expected, I think you see a bond rally. If it comes in hotter than expected, then I think we're headed to test maybe 470 handle on the 10-year. And maybe we get back to 5% on the 2-year. If not, we could set up for a rally here, and looks like a little bit of a head and shoulders formation here, forming across the bond yields. Now, been a pretty dramatic repricing. This is the 3-month change, so start of the year till the end of March. Where does the market price Fed funds to be? And you saw, I think we were kind of crazy. We thought that we were going to cut, down to 379, which was over 100 basis points of cuts, and now we've repriced less cuts, going down a little less than 100 basis points now through the end of the year. And so I think that maybe more in line. I think the Fed wants to cut at least once this year. They're going to be data dependent. They were so late to hike rates in 2022. We were doing QE when headline CPI was 9%. We were doing QE still in March of 22. And so they don't want to be behind the curve. They're acknowledging that there are some signs of continued slowing in the economy, and they want to start down the path. So I'm not in the no cut camp. I'm in the they will cut at least once. And if data gets worse and or inflation comes down more meaningfully, they can cut more. And interesting enough, Bullard, ex-governor, who was one of the biggest hawks through the rate hiking process, he actually came out, it was either last night or tonight or today, talking that he thinks that inflation's made meaningful progress lower, the Fed has accomplished their goal, and that he thinks that a normalization is needed and that 3 cuts would be totally appropriate this year. So, not a lot of opinions, a lot of governors, but Bullard was one that was right on the way up, and so maybe he's right on the way down. I'm in the at least one camp. And in the big scheme of things, I joke, does it really matter if they cut in June or in the fourth quarter, 1 cut, 2 cut, red cut, blue cut? A little homage to Dr. Seuss. It's if you're not trading SOFR futures, it doesn't really matter in the big scheme of asset allocation. It's more about the Fed is done hiking, inflation's coming down. If something bad happens systematically, they can cut rates, they will cut rates. I think that's the big picture. I think that's why equities are where they are. So it's more about, can they cut rates, not when and how much they will. You're just nickel and diming right now to make bets on that, I think. So returns across fixed income were positive for March, but we've seen a backup since then, obviously, over these last couple of days in April. But March was a up month for fixed income. You can see high quality fixed income treasuries, agency mortgages up about 60 to 100 basis points. The securitized sectors all positive on the year, especially CMBS, which was one of the laggards of last year. Floating rate assets doing well, CLO, triple Bs, levered loans, and risky floating rate assets doing the best. You can see up 2% there. If I showed you April through today, all this stuff is reversed. But year to date through March, it's kind of been a sideways market for fixed income. Credit's been winning. Duration is not. You can see negative returns in high quality fixed income on the left-hand side. And really the laggards of last year and risky stuff is done best. So the credit curve has really flattened. The marginal yield pickup to go take more credit risk has diminished. So it's not a great time to buy risky credit. It's done really well. Spreads are tightened in a lot. But some parts of the market are still cheap to others. So this is our what's cheap report that we've looked at on a monthly basis. You can see at the very bottom, we've had a tremendous spread rally in investment grade corporate bonds, high yield, and emerging markets. All those sectors are now sub 10%, meaning they, for example, IG is 7th percentile. It's only been more expensive 7% of the trading days over the last 10 years. Emerging market corporates, 4th percentile. It's only been more expensive 4% of the trading days over the last 10 years. Many of these securitized sectors were higher on this chart last month. They were even higher end of last year, and they've all been coming down. Even BBB CMBS on the far right has been coming down. The lone wolf is agency mortgages continue to lag the corporate credit markets. In all these markets, they need the demand to come back in. They need the money managers and banks to come back into the market. And I think the money managers are in the market. It's just that they need flows. They need flows to come back into bond funds. And I think you need actual rate cuts, not just the threat of rate cuts, in order for money to move out of T-bills and into funds. And also you need you need a less non-inverted yield curve for banks to more meaningfully participate in the market in more full force. But we talked about these sectors look cheap to corporates. These spreads should come in. These shows you the relationships of the different securitized sectors to corporates. We've looked at this slide many months, and the line is coming down. So these sectors are playing catch up to the corporate credit markets. Corporate credit continues to tighten, which is why these lines are not more aggressively dropping. But here you can see the month-to-month spread change. On the left-hand side, IG Corps are down 6 basis points. And as you move to the right, you see that some of these securitized sectors, look at BBB CLOs, BBB residential mortgage-backed securities, bank loans that have lagged high yield, even agency mortgages, they've all tightened in spread. They just haven't tightened in aggregate as much as corporates have from kind of the wides of October of last year. Look at BBB CMBS in 51 basis points. The risk takers in the marketplace rotating down the capital structure to the next marginal highest yielding place in hopes of those sectors tightening. And this is typically how the market works. First, the high quality stuff tightens in, and then there's a chase for yield, and market participants go down the credit curve into riskier parts of the market, and you see tightening there. So this is kind of textbook bond market playing out. Now looking at equity performance, the land of gains, the March returns. You see kind of 1 to 5% returns across the board year to date. The big winner, the Nikkei, making all-time highs, also all-time highs in the S&P. Very strong returns across the board in domestic markets, tech-led markets. Emerging markets continues to kind of be the laggard there. You can see up 3%. And then looking at the different sectors, this is now sorted March to date. Energy, a laggard last year, playing catch-up. So seeing a big catch-up in energy, not surprising with oil prices making new highs on the year. But as we look at it in the yellow year to date, momentum winning, tech winning, growth winning, and real estate over on the far right, one of the laggards out there. So healthcare, some of the defensive stuff, more bond-like stuff, not doing as good. But it has been the land of gains for equities. Everyone wishes they own more, so do I. Hard to buy here at the top. I guess at least we're seeing a little bit of a sideways action. Another thing that's been winning has been commodities. It's something that had lagged over the last couple of years. You can see gold up a lot, gold making new highs every day. It always worries me when gold becomes a hot topic on CNBC and Bloomberg. Nobody wanted to talk about gold when it was sitting at 1,800, and now everyone seems to be talking about gold. I think a lot of it has to do with it's not really US-driven demand, a lot of demand coming out of Asia, India, related to maybe some currency concerns out there. Like imagine if you're in China, do you want to buy, you want to keep your money in the banks? Maybe they can take it from you. Do you want to put your money in real estate? That seems to not be doing well. Do you want to put in the market in the Chinese equity market that has not been doing well, or do you want to own physical gold? And so I think that's one of the things that's going on out there, is that it's a place to park your money that's not, that's historically been a safe haven. Maybe even some people with equities at all-time highs wanting to put their money somewhere else as a hedge. We see energy up a lot, copper up a lot. So copper being up a lot, that's kind of a sign of maybe that's a resurgence in global economic growth, right? Again, this is all goes hand in hand on why there's now concerns maybe on interest rates having to move higher, which they have already. I think interest rates have moved higher on the concerns of the re-emergence of growth. So the market's kind of pricing it in. You can see the global commodity index year to date up 14, Bloomberg commodity index up 4, and agriculture, I guess, is the only thing that's down. So it's been I think year to date numbers don't look that impressive, up 4% for the Bloomberg commodity index, but that's because we had a sell off to start and then a rally. But off that lower level, we've seen a pretty big move up in commodities. Looks like it's just past its 200-day moving average, so maybe a little bit overbought here, as does the equity market look a little bit overbought. I look at some sentiment data, and The bull-bear investor sentiment was the highest it's been in since like something in the 1980s. I forgot the exact date. And then another one was the net money managers long is the longest that it's been since November of 2021, which was the prior peak before the sell-off in equities with rates rising. So, not saying that equities are doomed. I'm just saying that they definitely have had a great run, and from some sentiment metrics, they do seem like they're a little bit overbought. So, take that with a grain of salt. And last but not least, what's going on with the dollar? With the rates headed back higher, the dollar has been weakening a little. The dollar has been strengthening. These are very correlated, and you can see that the dollar index is in the blue and the 10-year Treasury yield is in the red, and they do move in tandem. And with the backup in rates, we see that the dollar has moved off the lows that it was in January. So it's been a great run since October lows, the land of gains. Hopefully you enjoyed some of those lands of gains. We looked at what looks kind of cheap in the fixed income space. Still think there's room to catch up in those securitized markets. Investment grade, high yield, EM corps, looking on the expensive side, had a great run. Commodities having a move higher as well. Maybe going to take a pause here. I think a lot of it depends on what happens tomorrow with the CPI numbers. If CPI comes in lower than expected or even as expected, I think that's going to be good for bonds. That'll be good for risk assets as well, perhaps. If inflation pokes higher, then higher for longer, and maybe a backup in rates will finally hurt this equity market that doesn't seem to have anything that can hurt it. So good luck out there, and we'll see everyone next time on Channel 11. Thank you.